Now, Peter has $20,000 cash on hand, which we can all agree is perfect for quick access, but it's not the best way to preserve his wealth. The truth is that if you want to keep money from losing value during high inflation, you shouldn't just let it sit idle. Instead, you can make your money work for you by investing in dividend stocks that offer returns higher than the inflation rate. This video will guide Peter on how to pick the best dividend stocks and show you how he can build a strong dividend portfolio, which will potentially earn him almost $3,000 in dividend income. Stay with me because in the end of this video, I'll show you how Peter's initial $20,000 investment can reach over $170,000 in the next couple of years. And without further ado, let's get into it. First things first, Peter needs to understand how dividend investing works. Dividends are regular payments made by a company to its shareholders, usually from profits. Companies that pay dividends are often stable and established, sharing a portion of their earnings with investors. This provides a steady income stream and signals the company's financial health and commitment to its shareholders. Here's the thing though, in an inflationary environment, the purchasing power of cash decreases over time, but investing in dividend-paying stocks helps counter this by providing returns that can outpace inflation. Instead of letting money depreciate in the bank, put it in dividend stocks as a way of preserving and growing your wealth. Warren Buffett himself, who we're going to use as a reference in this video, often highlights the importance of dividends and reinvestment. His investment philosophy focuses on buying quality companies with a strong track record of profitability and shareholder returns. He reinvests dividends to benefit from compounding, where earnings generate more earnings, leading to exponential growth over time. With a basic understanding of dividends, Peter can now go ahead and choose the best dividend-paying stocks, which we'll discuss next. Here's the thing, not all dividend stocks are the same. To ensure his $20,000 investment yields the best returns, Peter must focus on some key criteria: dividend yield, dividend growth, payout ratio, financial health, and industry strength. Warren Buffett's investment philosophy emphasizes value investing, which simply means looking for companies that are undervalued relative to their intrinsic worth, with strong management teams and predictable earnings. To draw a much clearer picture, Peter needs to find some companies that align with Buffett's principles. Coca-Cola, for example, has a long history of increasing dividends, a strong brand, and a global presence. Johnson & Johnson is known for its financial stability and consistent dividend growth. And Procter & Gamble is known for its diverse product range and reliable dividends, and these two are solid choices. Let me explain how he does it. Peter decides to split his $20,000 investment evenly among these three companies, with Coca-Cola offering a dividend yield of 3%, Johnson & Johnson yielding 3.2%, and Procter & Gamble yielding 2.4%, we can calculate his potential earnings. Investing $6,667 in Coca-Cola, he expects an annual dividend of approximately $200. With Johnson & Johnson, his $6,667 investment would yield about $213 annually. Procter & Gamble would provide roughly $160 in annual dividends from his $6,667 investment. In total, Peter expects to earn about $573 in dividends in his first year from these three companies alone. Now that he has some high-quality dividend stocks in his portfolio, Peter is on his way to achieving his financial goals. In the next chapter, we're going to show you how Peter can make money with Dividend Aristocrats and explore why these companies are a cornerstone of his investment strategy. You might be wondering what I mean by Dividend Aristocrats. Let me explain. These are companies in the S&P 500 that have not only paid dividends consistently for at least 25 years, but have also increased their dividend payouts annually. These companies are champions of stability and reliability, often operating in sectors that provide essential goods and services. As it turns out, Warren Buffett values companies that consistently grow their dividends because it reflects their financial strength and management's commitment to returning capital to shareholders. On top of this, these companies have strong cash flows and are less likely to cut dividends during economic downturns. For Peter, Investing in Dividend Aristocrats means tapping into a steady and growing income stream. Peter already has 3 top Dividend Aristocrats for his portfolio in mind: PepsiCo, McDonald's, and 3M. PepsiCo, known for its robust portfolio of beverages and snacks, has a 48-year streak of increasing dividends and offers a current yield of 3%. McDonald's, with a yield of 2.6%, has been raising its dividends for 45 years and maintains a powerful brand. Lastly, 3M, a diversified technology and manufacturing company, has increased its dividends for 63 consecutive years and provides a 2.7% dividend yield. Peter decides to invest $6,667 in each of these 3 companies. With PepsiCo's yield, he expects an annual dividend of about $200. McDonald's would provide him with approximately $173 annually from his investment, while 3M would yield about $180 annually. This results in a total expected dividend income of roughly $553 in the first year from these 3 Dividend Aristocrats. Now, these companies have one advantage. They all have long histories of dividend increases, so they are much less risky if we compare them to other dividend-paying stocks. In the next section, we'll explore high-yield dividend stocks, which will offer higher returns but will need a careful approach to risk management. Here's what you need to keep in mind. High-yield dividend stocks offer the potential for greater income but come with higher risk. These stocks typically belong to companies that pay out a large portion of their earnings as dividends. To balance risk and return, Peter must carefully evaluate the financial health and sustainability of these companies' dividend payments. To put this into perspective, Peter identifies 3 high-yield dividend stocks: AT&T, Altria Group, and Omega Healthcare Investors. AT&T offers a substantial yield of 5.8%, making it an attractive option for income-seeking investors. Altria Group, known for its strong dividend history, provides a yield of 7.9%. Omega Healthcare Investors, a real estate investment trust specializing in healthcare facilities, yields a solid 7.5%. Peter now puts $6,667 into each of these high-yield stocks. With AT&T's yield, he expects an annual dividend of about $387. Altria Group would provide approximately $527 annually from his investment, while Omega Healthcare Investors would yield about $500 annually. This results in a total expected dividend income of roughly $1,414 in their first year from these 3 high-yield stocks, which is a great amount to maximize your earnings. However, you must be cautious about the potential risks associated with these investments. In the next chapter, we will dig into real estate investment trusts, or REITs, and how Peter can make even more money with them. Now, in case you're wondering what REITs are, these are companies that own, operate, or finance income-producing real estate. They offer investors a way to gain exposure to the real estate market without directly owning property. The best part about REITs is that they are required by law to distribute at least 90% of their taxable income to shareholders as dividends, making them a popular choice for investors like Peter. Let me explain how he can take advantage. Peter identifies 3 top-performing REITs: Reality Income Corporation, Digital Realty Trust, and Annaly Capital Management. Reality Income Corporation, known as the Monthly Dividend Company, offers a yield of 4.5% and has a strong track record of dividend payments. Digital Realty Trust, which focuses on data centers, provides a yield of 3.4%. Annaly Capital Management, a mortgage REIT, yields an impressive 12.9%. We're going to use the same $6,667 investment in each of Peter's REITs that we just introduced. With Realty Income Corporation's yield, he expects an annual dividend of about $300. Digital Realty Trust would provide approximately $227 annually from his investment, while Annaly Capital Management would yield about $860 annually. This results in a total expected dividend income of roughly $1,387 in the first year from these 3 REITs. These are going to serve a great deal in diversifying his portfolio. which Warren Buffett himself recommends if you want to subdue the risk on investment. Let's see how Peter can build a balanced dividend portfolio by combining Dividend Aristocrats, high-yield stocks, and REITs. Here's where things start to get exciting. Peter allocates his $20,000 savings as follows: 20% to Dividend Aristocrats, 50% to high-yield stocks, and 30% to REITs. This means he invests $4,000 in Dividend Aristocrats, $10,000 in high-yield stocks, and $6,000 in REITs. For Dividend Aristocrats, Peter invests $4,000 evenly across PepsiCo, McDonald's, and 3M. With an average yield of 2.8%, he expects an annual dividend of approximately $112 from each company, totaling $336. For high-yield stocks, Peter invests $10,000 evenly across AT&T, Altria Group, and Omega Healthcare investors. With an average yield of 7%, he expects an annual dividend of approximately $700 from each company, totaling $2,100. For REITs, Peter invests $6,000 evenly across Realty Income Corporation, Digital Realty Trust, and Annaly Capital Management. With an average yield of 6.9%, he expects an annual dividend of approximately $138 from each company, totaling $414. If we combine these investments, Peter's total expected annual dividend income is roughly $2,850. And if he reinvests this dividend income, Peter's investment has a huge potential to grow over time and generate even higher returns because of the compounding effect, which I'll explain in the next section. To put it in simpler terms, reinvesting dividends is a strategy that allows investors to purchase more shares of the dividend-paying stock with the dividends they receive. This process accelerates the growth of an investment through the power of compounding. According to Buffett, compounding is the eighth wonder of the world, and reinvesting dividends is a practical way to activate this powerful concept. To paint a clear picture, Peter decides to reinvest all his dividends to maximize growth. With an initial investment of $20,000 and an average dividend yield of 7.57%, he earns approximately $1,514 in dividends in the first year. The truth is that Peter's investment grows faster by reinvesting these dividends, as each reinvested dividend generates additional dividends. So, let's forecast Peter's investment growth over 10, 20, and 30 years with continuous reinvestment. In 10 years, his $20,000 investment could grow to approximately $41,045, assuming an annual growth rate of 7.57%. In 20 years, the same investment could grow to around $84,000. Over 30 years, Peter's initial investment could reach nearly $173,000, and this is why you should reinvest your dividend income. But most importantly, you have to monitor and adjust your portfolio accordingly to avoid falling out of track and making mistakes that can cost you a fortune, which we're going to talk about next. Peter knows that his dividend investment journey requires ongoing attention and adjustments to ensure long-term success. You see, market conditions and individual company performance can change, impacting dividend yields and overall returns. So, Peter commits to a routine of quarterly portfolio reviews to assess his investment's performance and make necessary adjustments. And in case you're not aware, adapting to market changes is another key aspect of successful investing. Warren Buffett advises investors to remain flexible and open to new opportunities while maintaining a long-term perspective. With this in mind, Peter plans to stay informed about economic trends, industry developments, and company news to make well-informed decisions. Now, let me make this clear. Buffett's approach to portfolio management says that you should hold on to high-quality investments while being prepared to sell those that no longer meet performance expectations. And if you adopt this approach, you can focus on maintaining a portfolio of solid dividend-paying stocks. And remember to replace underperforming assets if you really have to. So what's the key takeaway? As Peter's journey shows, it's not too late to start building a dividend portfolio. Anyone can do this. You too can create your own path to financial freedom using this guide. So begin your own dividend investing journey right now. If you don't have $20,000 in savings like Peter, you can always start with a smaller amount. Check out our video titled Dividends from $5,000 to see how you can live off dividend income with $5,000 starting capital and how you can maximize your earnings.